Hi, welcome to the first mini lecture for Chapter 6. Up to this point, we've been learning how to record and report business transactions for service businesses. In this chapter, we learn how to account for merchandisers, which are companies that sell goods or merchandise instead of services. These companies do not create the products they sell. They buy products from manufacturers or wholesalers and then mark them up and sell them to us. For this chapter, I'm going to be using both the Chapter 6 summary notes, which you can find in the Chapter 6 folder in Blackboard, and I'm also going to be using some textbook pages as well. So let's just review for a moment. Service companies, they are companies that sell services. Merchandising companies buy products and then mark them up and sell them to us. Let's take a look at their operating cycles. And an operating cycle is the series of activities that a company undertakes to generate revenues, which ultimately lead to cash. So I'm going to take page 260 out of our textbook here, and then we're going to take a look at Exhibit 6-1, the operating cycle. Service companies have a fairly simple operating cycle. They provide the service, and then they collect cash if it is a cash sale, or if it's a sale on credit, on account, we collect cash a bit later, and then we use that cash to pay for operating expenses. A merchandiser has a bit more complicated operating cycle. They first have to buy the products that they're planning to sell. We call that inventory. And then they sell the inventory and collect the cash either immediately or later if it's a sale on account, and they use that cash to both pay operating expenses and later to buy more inventory. The next thing I'd like to do is take a look at three key differences in balance sheet and income statement of service companies versus merchandising companies. But again, I think it's going to be easier to look at the textbook pages. So we're going to take the same information and look at it in a bit more colorful format. Okay, so we've got an example of a service company, and that would be Planet Fitness. And then we've got a merchandiser, and we've used Walmart here. Now, we're going to keep things simple in this chapter. I do know that there are some service companies that also sell products. For example, Delta Sonic both washes cars and sells products as well, but we're going to keep them separate in this chapter. We're going to treat service companies separately from merchandising companies to highlight the differences between them. Okay, first let's take a look at the balance sheet. A balance sheet of a merchandiser has a current asset account called inventory. An inventory item is a product that you're planning to sell to your customers. We mark it up to a selling price and then sell it. We don't see inventory here on Planet Fitness's balance sheet. It's a service provider, but we do see supplies. Supplies differ from inventory in that they are bought for internal use. We're not going to be marking them up and selling them to our customers. Now let's take a look at our income statement. The income statement, first of all, it has revenues on it. For a service provider, we call that service revenue. For merchandisers, because they're selling goods, we call that sales revenue. We also have a new expense account for merchandisers. It's called cost of goods sold. While the account name doesn't have the word expense in it, this is the largest expense for merchandisers. We take the selling price of what was sold, sales revenue, and then subtract the cost of what was sold, which is called the cost of goods sold, to find our gross profit. So gross profit is a calculation. So now let's switch to the next page of our notes, and we're going to be covering Learning Outcome 6-2, which is to explain the differences between periodic and perpetual inventory systems. We're going to start by talking about three accounts that are particularly important to a merchandiser. We've already talked about the three of them actually. Let's just do a quick review. Inventory reports the merchandiser's cost of acquiring goods that it has not yet sold. This is a current asset on the balance sheet, whereas sales revenue and cost of goods sold are both on the income statement. Sales revenue is the selling price of what we sold. Cost of goods sold is exactly what it sounds like, the cost of what we sold. Now, what I'd like to do is pull out another page from our textbook, because rather than looking at this relationship horizontally, I think it's easier to understand if we do this represented like in Exhibit 6-3. And this is called the cost of goods sold equation. It's the relationship between inventory and cost of goods sold. If we are a brand new company, we will not have any inventory left over from last period. But let's say that we have been in business. In that case, we might have some inventory that was not sold at the end of last period. That's called this period's beginning inventory. Purchases are what we buy in this period. So if we take our beginning inventory of $4,800 plus what we bought in order to sell to customers as inventory this period, $10,200, 4,800 plus 10,200 gives us the cost of everything we could sell this period. We call that the goods available for sale, 15,000. Now, goods available for sale will either be sold during the period, and if so, that will end up as cost of goods sold on our income statement, or if we don't sell them, they'll end up as inventory on our balance sheet. If, for example, we know what was sold, we could calculate by subtraction what should be left. 15,000 minus 9,000 should leave us with $6,000 in our ending inventory. If we know what's left, our ending inventory, we could calculate by subtraction what we sold, $9,000. And that's essentially the difference between the periodic and perpetual inventory systems. So let's learn about those by looking at our notes. With the periodic inventory system, that updates our inventory records for merchandise purchases, sales, and returns only at the end of an accounting period. A drawback is that we don't have accurate records of inventory during the course of the period. Now, why would a company do that? Why would they use a periodic inventory system? Well, to tell you the truth, most companies don't any longer. They use perpetual systems, but that's because of changes in technology. Now we have cash registers that are also computers. So, as inventory is sold, we not only record a sale, but we also can adjust our inventory accounts. But that wasn't always the case. And there may still be some small businesses that use the periodic system because their cash registers are not computers. So how do we determine the cost of goods sold if we're not keeping track of it? Well, to determine those amounts, we physically have to count the inventory, which we do at the end of the accounting period. And then what we say is, okay, we know our beginning inventory, we know what we bought. That gives us the goods available. If we subtract out what our ending inventory is, then we can calculate that our cost of goods sold is $9,000. Let's think about that. We had $15,000 available and we have $6,000 left. Is it good to assume that everything that was not there was sold? Probably not, because some of it could have been stolen. So this is not a good system for inventory management. A much better system would be the perpetual inventory system. With this system, we update inventory records every time an item is bought. We bring it into the warehouse and we scan it into our inventory records. When merchandise is sold, we use the barcode scanners both to record the selling price of what we sold and to remove that item from inventory records. So it's a much better inventory control system. It provides for continuous tracking of transactions, which allows companies to instantly determine the quantity of products on our shelves. Another benefit is we can estimate shrinkage. Shrinkage of inventory is the term for loss of inventory due to theft, fraud, and error. If we know what was sold, $15,000 available, $9,000 sold, then we should have $6,000 of inventory left. Let's count it. Let's do a physical inventory count. And if we don't have that much left, then we've suffered shrinkage. So we can calculate the amount of that shrinkage, and then we can do a book to physical adjustment. Sorry, the notes are hard to see there. A book to physical adjustment, and what we do there is we reduce the inventory account with a credit because it's an asset, and we debit the cost of goods sold with a debit. We debit the account with a debit. That would be obvious. Okay, let's see if we can use an example of this from our text. Page 264 at the top here. I'll make this a little bit bigger. I'm having trouble with my Zoom today. Okay, so here's our inventory records in the left box. We've got the beginning inventory, units times cost equals total cost. That's what we started with. And then we made some purchases. We bought another 3 units at the same cost. So we have goods available for sale, 6 units for a total of $600. And we know according to our sales records that we sold 2 units, so we should have 4 left. 600 minus 200 equals $400 worth of inventory that we should have on hand. Let's go count it. We count the inventory and there's only 3 left. There should be 4. So now we have to do a shrinkage journal entry to adjust our inventory account and our inventory records. We debit the cost of goods sold and we credit the inventory account by 1 unit, $100. Now it's important to remember that you will still need to count your inventory records occasionally and at least once a year to ensure that your accounting records are accurate and that you are reporting inventory at an accurate amount and that shrinkage is detected as well. Okay, we're going to end our mini lecture right now and we're going to do a few problems. Take a look at the Chapter 6 folder for those problem demonstrations. Have a great day.